How Wall Street broke your rent. The fire sale. The street looked the same mailbox, same cracked driveway, same tree stump from the hurricane years ago. But in early 2009, the for sale sign in the front yard wasn't a symbol of new beginnings. It was a clearance tag. Banks were unloading homes by the thousands, entire neighborhoods sold off in bulk to anyone with enough cash and a spreadsheet. That's how giants like Blackstone's Invitation Homes and Pretium Partners Progress Residential got their start, swooping into foreclosed neighborhoods with billions in cheap money and buying everything in sight. What ordinary families lost, Wall Street turned into inventory. Outside Atlanta, blocks of tidy three-bedroom homes went for less than the price of a Manhattan studio. A single fund manager could walk through a cul-de-sac and buy every house before lunch. For families already reeling from foreclosures, that frenzy meant something even harder to swallow. Someone else was buying their future at a discount. Fast forward 15 years. Those same streets are full again, but the names on the leases aren't local. A family who'd once owned their house outright now rents it for triple the mortgage payment they lost. Their new landlord? A publicly traded fund headquartered in New York. The dream of ownership had been flipped into a perpetual payment plan, a carefully engineered scam hidden behind market forces. Outside Atlanta, blocks of tidy three-bedroom homes went for less than the price of a Manhattan studio. A single fund manager could walk through a cul-de-sac and buy every house before lunch. For families already reeling from foreclosures, that frenzy meant something even harder to swallow. Someone else was buying their future at a discount. Fast forward 15 years. Those same streets are full again, but the names on the leases aren't local. A family who'd once owned their house outright now rents it for triple the mortgage payment they lost. Their new landlord? An investment trust traded on Wall Street. The dream of ownership had been flipped into a commodity, owned, managed, and priced like oil futures. Somewhere between the foreclosure auctions and the glossy investor prospectuses, housing stopped being about shelter and started being about yield. Renting isn't just expensive, it's engineered that way. Engineered by financial firms that saw what others missed, that what broke ordinary Americans could build extraordinary profits. To understand how we got here, we have to go back to the years when neighborhoods were bleeding value and Wall Street smelled an opportunity. When the line between home and investment blurred so completely that ordinary people never saw it happening. Because this isn't just about broken markets. It's about a system that turned the most human need, shelter, into an algorithm for cash flow. A crisis wasn't just survived, it was monetized. What started as a scramble for distressed properties became the foundation of a new empire. And that empire still collects rent every month. When homes became products. After the crash, entire suburbs looked abandoned. Overgrown lawns, padlocked doors, eviction notices curling in the sun. More than 6 million families lost their homes between 2008 and 2013. For the mortgage giants, it was devastation. For the financial world, it was inventory. Investors realized something. These weren't toxic assets anymore. They were underpriced houses sitting on streets ready to rebuild. Private equity firms, led by names like Blackstone, Pretium Partners, and Invitation Homes, began making calls to the banks that held the paper. By 2012, they weren't just buying foreclosed houses one by one. They were buying by the thousand. The model was simple. Use cheap capital borrowed at near-zero rates, sweep up single-family homes from distressed sellers, renovate them just enough, then rent them out at market rates. The margins looked irresistible. Housing had always been a fixed, illiquid commodity. Now it could be bundled, managed, and scaled like any other product. In just a few years, the single-family rental market transformed from a scattered patchwork of mom-and-pop landlords into the next Wall Street asset class. Analysts coined a new term, SFR, single-family rental. The acronym itself marked the shift. What was once a home now had a ticker symbol. In Tampa, Invitation Homes built algorithms that could identify undervalued listings within minutes of posting. In Phoenix, hedge funds sent representatives to courthouse auctions with cashier's checks ready. In Charlotte and Dallas, real estate agents stopped showing homes to families altogether because they knew institutional buyers would close faster, often sight unseen. From the outside, it looked like the revival the country needed. Vacant properties were occupied. Construction jobs came back. The housing market stabilized. But inside the numbers was something else. Ownership was moving from households to entities. The new landlords weren't neighbors. They were funds managing billions on behalf of pension plans and sovereign wealth funds. Rent payments that once circulated within communities now flowed into quarterly earnings reports. As the portfolios grew, so did the sophistication. Firms realized they could securitize rental income streams, just like mortgage debt. In effect, homeowners' former mortgage payments were reborn as rental-backed securities. Wall Street had recreated the very machine that crashed in 2008, only this time, it owned the collateral outright. For tenants, life under these corporate landlords carried a new logic. Repairs required approval from distant call centers. Rents were adjusted according to data models, not local wages. Renewal notices came from departments named revenue optimization. Stability, the core promise of a home, was slowly replaced by quarterly profit targets. One former homeowner in Las Vegas described it plainly. "It's like we're renting our lives back, one paycheck at a time." Her mortgage payment before foreclosure had been $1,200. The rent on the same house a few years later, under a new corporate landlord, was $2,000, with new fees for everything from maintenance calls to online payment processing. Still, investors poured in. These returns were predictable, tangible, insulated from market swings. People might pause vacations during recessions, but they never stopped needing a place to live. Housing, once the bellwether of middle-class security, was rebranded as a defensive asset. For Wall Street, that meant safety. For renters, it meant vulnerability. Behind the profits was a simple trade-off. Financial efficiency replaced human stability. Houses were no longer valued for living in. They were valued for how efficiently they could generate income. The neighborhood's worth came not from its schools or community spirit, but from the yield curve and cap rate. Meanwhile, the advertising softened the story. Corporate landlords emphasized reliability, professional management, consistent maintenance, modernized living. For a generation raised under economic uncertainty, renting from a brand seemed reassuring. The irony was that many of these same brands had bought their parents' foreclosed homes for pennies on the dollar. The shift also changed the psychology of ownership. Young families, already crushed by student debt and stagnant wages, found homeownership statistically out of reach. Each year, more of the available stock went to institutional buyers, and each year rents climbed higher. The American dream was transmogrified, from ownership to occupancy. Behind closed investment memos, executives called it scaling stability. Out in the real world, it felt more like renting permanence itself. The logic that once built communities was inverted. Instead of building wealth through equity, households now transferred wealth through rent. And this wasn't some unintended consequence. Hedge funds saw rental housing as a predictable cash generator precisely because homeownership had failed for so many. When you design portfolios around economic struggle, every missed mortgage payment somewhere becomes potential rent revenue somewhere else. By 2015, Blackstone's Invitation Homes controlled over 85,000 properties. Pretium's Progress Residential managed nearly 100,000 more. Together, their portfolios stretched across Arizona, Texas, Georgia, the very Sunbelt metros where the crash hit hardest. The same communities that lost the most now paid the most. But investors didn't stop at owning houses, they standardized them. Rent levels, maintenance schedules, tenant evaluations, all fed into central databases. Neighborhoods started to feel identical because financially they were. Each home was just another unit of revenue in a vast spreadsheet. That was the decisive shift. Housing was no longer a market of buyers and sellers. It was an inventory system, a product line, a managed asset class running on data, not dreams. And for every family still hoping to buy back into ownership, that reality meant competing not with another couple across town, but with trillion-dollar funds optimized to never lose a bid. It wasn't just homes being bought up, it was neighborhoods, identities, and futures. The country told itself the crash was over, that recovery was underway. But if you followed the money, you'd see something different. The crisis had changed form. It now collected rent on the first of every month. How Wall Street bought the suburbs. It started with a spreadsheet and ended with a map. Streets filled with foreclosure signs became coordinates on an investment model, rows and columns calculating yield, risk, and projected rent growth. Hedge funds realized they could buy not just houses, but entire markets. All they needed was scale. The blueprint came from the private equity world, roll-up strategies. Instead of one mega acquisition, firms built networks of smaller, property management companies, each operating under local names but tied to the same parent fund. On paper, they were dozens of independent landlords. In practice, they were one machine. A house in Atlanta, a house in Phoenix, a house in Dallas, all part of the same portfolio spreadsheet managed from a Manhattan office tower. Wall Street's advantage wasn't vision, it was volume. They didn't have to care about individual prices because they controlled entire zip codes. Platform strategies turned scattered properties into unified corporate empires. Progress Residential, owned by Pretium Partners, started as a modest investment. Within a few years, it managed tens of thousands of homes across the Sunbelt. Invitation Homes, backed by Blackstone, did the same, buying, merging, and absorbing smaller landlords until neighborhoods themselves became assets traded like shares. The process worked like this. Identify cities with high foreclosure rates but economic promise. Acquire local property firms, fold them under a national platform, then launch add-on acquisitions. Hundreds of small transactions stitched together into a single corporate body. These weren't flukes. They were deliberately engineered roll-ups modeled after retail franchise systems. Each acquisition added doors to the count, and door count meant power. The higher the total, the better the terms on financing, the stronger the negotiating position with maintenance contractors, and the easier it was to dictate rent levels across markets. Economies of scale compressed community life into margin optimization tables. Nowhere was it more visible than in the Sunbelt corridor. Atlanta's once affordable suburbs became laboratories for corporate ownership. In neighborhoods like Lithonia and Stone Mountain, bulk purchases turned entire blocks into rental-only districts. Charlotte saw the same pattern. Four-bedroom homes snapped up by LLCs that shared mailing addresses in Delaware. In Phoenix, an ordinary open house might see 30 offers, 29 from families, 1 from a fund with all cash. The agent didn't need a calculator to know who'd win. This bidding war was asymmetric. A typical homebuyer wrote an offer contingent on loan approval and an inspection. The corporate buyer wired funds within hours. No contingencies, no waiting, no emotion. Sellers in crisis gravitated toward the sure bet. By 2013, locals couldn't compete. The same companies that once securitized their mortgages were now outbidding them for their houses. Anonymous ownership amplified the trend. Every purchase moved through a maze of limited liability corporations registered in states with minimal reporting laws. One LLC might hold 10 homes, another 100, yet both tied back to the same fund. Public records showed only shell names. Renters mailing checks often didn't know who owned their home. This opacity wasn't accidental. It protected the investors while fragmenting accountability. Behind those legal shells stood concentrated power. In Metro Atlanta alone, institutional investors controlled roughly a quarter of all single-family rentals by 2025. Progress Residential's footprint reached more than 12,000 homes in the area. Invitation Homes, not far behind. In Charlotte, Jacksonville, Dallas, and Phoenix, corporate ownership topped 20%. The numbers looked small nationally but overwhelming locally. When one landlord owns 1 out of every 4 houses, market forces stop feeling free. They start feeling orchestrated. Local buyers noticed. Young couples found themselves competing not against peers, but against unseen bidders submitting offers minutes after listings went live. Inspectors were replaced by automated valuations. Realtors joked that open houses were obsolete. The house was sold before the coffee brewed. The result was a psychological shift. Ownership felt less like a dream and more like a raffle you'd already lost. Meanwhile, banks welcomed the new clientele. Bulk deals cleared balance sheets faster than retail sales, and funds brought mountains of capital. Titles transferred in packages, 500 properties at a time, each one another spreadsheet entry. Homes that once changed hands with personal letters and neighborhood introductions now moved between corporate desks with wire confirmations and signatures from attorneys who'd never seen the properties. Through these roll-ups and add-ons, Wall Street did something unprecedented. It built a national landlord. From afar, it looked efficient. Standardized leases, centralized maintenance, data-driven pricing. Internally, executives celebrated achieving scale parity with mid-size apartment REITs. Externally, it meant that the suburban starter home, the classic gateway to ownership, was now part of an investment product promising stable residential revenue to global investors. The financial engineering didn't stop at ownership. To fund expansion, firms issued bonds backed by rental income. each month's rent. Checks became interest payments for debt holders. Families didn't know it, but their rent-supported securities held in pension portfolios halfway across the world. Neighborhood life became a global cash flow stream. Communities began to change in subtle ways. Corporate landlords, focused on yields, avoided long-term tenants who might demand repairs. Turnover meant higher renewal rents and lower maintenance costs. The typical lease renewal came with an automatic rent increase, even when wages stayed flat. But for the funds, every vacancy and new lease was a measurable uptick in revenue. More churn meant more profit. Some city councils tried to push back, arguing that bulk ownership was destabilizing neighborhoods. But data arguments won out over emotional appeals. Wall Street's models claimed that professional management improved property quality, reduced crime, and preserved tax bases. Critics pointed to rising evictions and transient populations. But by then, the ownership maze made assigning responsibility nearly impossible. By 202, entire housing markets operated like sectors of a single corporation. When one company raised rents in Atlanta, similar increases appeared in Dallas and Phoenix within weeks. It wasn't collusion in the traditional sense, it was coordination through scale. When enough major landlords benchmarked against the same data, the distinction stopped mattering. For renters, the immediate impact was visibility. Identical homes with identical pricing trends, regardless of geography. For smaller landlords, it was extinction. Competing against institutional efficiency meant struggling to acquire, maintain, or finance properties under the same terms. The suburban housing market, once fragmented and local, consolidated like airlines or telecoms, few players, massive control. The irony was severe. Wall Street had rescued the housing market by making it unrecognizable. The same investors once blamed for the crash now owned the recovery. For them, stability wasn't measured in families staying put. It was measured in revenue continuity. If residents moved out, there'd be 10 applicants waiting, each screened through credit algorithms designed to minimize default risk. The business was never about homes, it was about flows. Across the Sunbelt, communities became portfolios. Streets that once echoed with kids playing after school now carried the quiet rhythm of managed assets. Landscapers on schedule, maintenance trucks with corporate logos, tenants cycling in and out each year. Financial scale created predictability, but it erased personality. By the mid-202s, large funds had perfected the playbook. Identify undervalued regions, deploy capital through layered LLC structures, capture local market share, securitize rental income, and reinvest profits into new acquisitions. The cycle fed itself, fueled by investor demand for real asset exposure. The Wall Street takeover of the suburbs wasn't a conspiracy, it was an equation. Each acquisition solved for yield. Each family's rent served as a variable. And when you multiply that equation across tens of thousands of homes, you don't just buy property, you buy influence. You buy the ability to set the baseline of what normal rent looks like. And once they owned enough doors, the math started doing something extraordinary for them, and devastating for everyone else. They weren't following the market anymore. They were creating it. The algorithm that set your rent. The rent increase notice landed in inboxes overnight. Same email, same timing, same new rate. A tenant in Dallas thought it was a glitch. Another family in Phoenix compared notes on social media and realized they'd both been hit with identical numbers. Within days, it was clear. This wasn't coincidence. It was pattern recognition by machines. Behind the scenes, landlords weren't setting prices with neighborhood comparisons or gut feelings anymore. They were using software, programs built to scrape mountains of rental data and dictate exactly how much a unit could charge. The most powerful of these systems came from a company called RealPage, whose product YieldStar promised landlords scientific rent optimization. It sounded efficient. It turned out to be transformative. YieldStar didn't just analyze one property. It pulled anonymized data from across portfolios owned by different landlords. Those data flows went back into the algorithm, which calculated the ideal rent increase to maximize revenue while minimizing vacancies. Each participating landlord received real-time recommendations on how far they could raise rents without pricing themselves out. The results were startlingly consistent. Synchronized rent hikes across markets that were technically supposed to be independent. For investors, it was a revolution. For tenants, it meant that competition, the invisible force that's supposed to keep prices fair, wasn't working the way it used to. when dozens of landlords used the same system to adjust. Their rents, supply and demand became coordinated math instead of organic negotiation. And since antitrust law hadn't caught up with algorithmic pricing, nobody could prove collusion in the traditional sense. The code was the connector. RealPage marketed its software as a tool to unlock hidden revenue potential. Internal case studies boasted that properties using YieldStar saw rent growth up to 7% higher than conventional management. That might sound minor until you multiply it across hundreds of thousands of units. One executive told the New York Times, "We have no problem pushing rents until the data tells us we've hit resistance." The data seldom told them that. Corporate landlords loved it because it made rent almost risk-free. Instead of relying on local managers to survey market trends, they could plug into a national data network that benchmarked every comparable listing. If a nearby unit sat vacant, the system adjusted instantly. The result was smoother revenue curves and fewer mistakes. Mistakes that usually meant owners leaving money on the table. But to tenants, those efficiencies blurred into something else: uniform scarcity. In one Seattle complex, residents reported identical rate increases to the exact dollar, despite differences in square footage and lease terms. A renter who called the office to negotiate was told, politely, that prices were automatically updated and not discretionary. For them, a conversation about affordability turned into a dialogue with code. The logic behind algorithmic pricing wasn't entirely new. Airlines had been using yield management systems for decades, adjusting ticket costs according to demand. Hotels followed, but housing was different. Losing a flight or a night's stay was an inconvenience. Losing a home was life disruption. These programs treated leases like bookings, temporary revenue slots to be filled at optimal price points. The algorithm didn't see a family, only an occupancy rate. In cities like Dallas and Atlanta, the ripple effect was extreme. When one of the major corporate landlords adopted YieldStar and set higher rents, rivals often mirrored those levels to stay competitive on paper. Competition morphed into alignment. And because many of these firms shared overlapping investors, including large private equity funds, the incentive was to maintain high rent levels rather than fight for tenants with better deals. The few local landlords who tried to offer moderate rates found themselves invisible. Online listing platforms, also powered by algorithmic comparisons, favored standardized pricing bands. A modest rent looked like an outlier. Software trained to maximize landlord profit learned to suppress lower prices the way streaming platforms bury niche films. For renters searching online, variety vanished. For regulators, the issue sat in a gray zone. Traditional antitrust rules focused on human agreements, two or more companies explicitly coordinating prices. But here, the alignment happened through shared data services. No phone calls, no meetings, just algorithmic suggestions accepted by humans eager to keep pace. When an antitrust lawsuit finally emerged in 2023, plaintiffs argued that RealPage acted as a hub for price coordination. The defense countered that it was simply an analytics provider using publicly available data. Meanwhile, the everyday consequences multiplied. Eviction filings crept up as rent burdens grew. Wage growth lagged behind the software's calculations. Local economies found themselves looped into a feedback mechanism where rising rents were justified by rising rents the program itself had encouraged. And because most algorithms were designed to favor revenue stability, they rarely recommended lowering rent, even in downturns. One renter in Memphis described opening their renewal notice. It was $40 more. Small enough not to move, just big enough to hurt. That balance was precisely what made the algorithm so effective. It was engineered to find the pain point tenants could bear without leaving. Economists call it price elasticity. RealPage called it optimization. Internally, some property managers voiced discomfort. Emails leaked from industry webinars revealed concerns about optics and public perception of uniform pricing. But as long as the method produced returns, the resistance stayed quiet. In investor presentations, rent optimization software became a key talking point, a guarantee of predictable growth in uncertain markets. For analysts, it was proof that housing could perform like a tech stock. The broader landscape shifted as smaller landlords adopted similar tools. Competing software platforms emerged, each promising data-driven pricing calibrated to regional inputs. Even mom-and-pop operators could subscribe, enter their property details, and receive algorithmic rent suggestions. Slowly, human discretion disappeared from the rental market altogether. The entire pricing ecosystem began to oscillate within the gravitational field of automated guidance. And still, few renters had any idea it was happening. Lease renewals didn't mention data analytics. Terms like revenue optimization stayed buried in shareholder documents. The process was invisible by design. Transparency was bad for performance. If tenants understood the mechanism, they might resist en masse. The system's success depended on renters behaving individually. Each person thinking their rent hike was just bad luck, not a synchronized policy decision emanating from corporate servers. The irony was that even landlords weren't fully in control. In some cases, property managers who tried to override algorithmic recommendations were reprimanded for deviating from standard operating procedure. Power had shifted again, this time from landlords to the software they used. Housing markets were now driven by code that prioritized yield curves over human context. What made it more disturbing was how seamlessly the algorithm fit the broader corporate strategy. When Wall Street investors owned huge chunks of the housing supply, they needed a way to manage price consistency across geographies. RealPage and systems like it offered exactly that, a unified control panel for rent. The data didn't just reflect the market, it shaped it.